Welcome to This Explainer. Look, today we're doing something a bit different. This is a critical briefing, really tailor-made for you, chief investment officers, pension fund managers, and institutional asset allocators. We are going to completely rip up and reevaluate how you look at risk, asset allocation, and honestly, the very definition of capital itself. If you're a fiduciary, sitting there, tasked with defending the long-term wealth of your beneficiaries, well, you're in exactly the right place. Let's dive right in.
I want to kick things off by challenging a huge foundational assumption that's probably baked right into your institutional portfolio. Warren Buffett has this amazing, stark warning. He points out that currency-based investments, your bank deposits, money market funds, long-term bonds, everyone thinks they're safe. But as he says, they're actually among the most dangerous of assets. Crazy, right? But why? Because while their nominal value looks nice and stable on a screen, the real risk is absolutely massive. They literally destroy your purchasing power over time.
So the absolute crux of this is understanding the massive difference between currency and money. Speaking as a financial advisor looking at long-term institutional wealth, I really urge you to decouple these two concepts in your head. Currency? That's just a short-term medium of exchange. It's what we spend at the store. Money, true money, is long-term purchasing power. It's what you invest. Real investing is simply the act of forgoing consumption today so you can massively increase your purchasing power above and beyond inflation tomorrow.
All right, here's our game plan for today. We'll cover 1. Currency versus purchasing power. 2. The illusion of safe cash. 3. The real asset trinity. 4. The RASA framework. 5. Dynamic versus static allocation. And finally, 6. The institutional imperative.
Okay, let's jump right into section 1, currency versus purchasing power. We really need to look at how the actual definition of money has morphed over the last few decades. We kind of have to look in the rearview mirror to understand where we are right now. Back in 1944, the Bretton Woods system locked global currencies to the US dollar, which was backed by physical gold. Fast forward to 1971, and Richard Nixon completely changes the game. He acts as the gold standard, basically setting money free to just float in the wind. And honestly, once those guardrails were removed, this relentless erosion of purchasing power was unleashed. It led us straight into the fiat currency reality we're all wrestling with today.
Which brings us to section 2, the illusion of safe cash. We're going to expose the hidden tax of inflation that makes holding uninvested capital basically a guaranteed losing bet.
86%. I mean, wow, let that sink in for a second. That should be a total wake-up call. Since 1965, the US dollar has plummeted a staggering 86% in actual purchasing power. It literally takes $7 today to buy what just $1 bought back then. Think about your portfolio. If you're sitting on large passive allocations in cash or low-yield long-term bonds because you think they're your safe haven, you're actively locking in a continuous compounding loss of wealth. It's safe on paper, but incredibly dangerous in reality.
And this really hits the nail on the head regarding the opportunity cost of that so-called safety. Imagine you hold a term deposit yielding 5%, but inflation is running hot at 6%. You aren't making 5%. You actually have a negative 1% real return. You're sliding backward. Now compare leaving $250,000 in cash for 20 years versus deploying it into a diversified pool of productive alpha-generating assets. Sure, the cash might double in nominal terms, but those productive assets, they can quadruple. That is how you fundamentally protect and grow your real purchasing power.
So how do we actually build the defenses here? Let's move to section 3, the real asset trinity, where we meet the ultimate protectors of your purchasing power.
So Warren Buffett loves to talk about productive assets. In the institutional space, we're zooming in on real assets. They absolutely deserve a spot in your portfolio because they offer this incredible trinity of characteristics. We're talking diversification away from your standard stocks and bonds, return enhancement, and crucially, direct inflation hedging. But here's the rub. There's a catch. No single real asset perfectly hits all 3 of these targets at once. Since there is no single magic bullet asset, the real game changer is a balanced real asset basket. You mix 10-year tips, which give you guaranteed purchasing power preservation, with gold, which is your classic, historic direct inflation hedge. Then you throw in energy and commodities. Historically, those guys deliver 6 to 8% returns precisely when inflation is spiking. By equal weighting these pieces, you build a basket that captures that entire trinity we just talked about. It gives you a highly unique shield against major macro risks.
All right, let's shift to section 4, the RASA framework, and see how this all comes together technically. As an asset allocator, you can't just fly blind. You need rigorous metrics, right? Enter the Real Asset Sensitivity Analysis, or the RASA framework. RASA systematically crunches the numbers on how different assets react to macroeconomic risks like inflation and growth. It tracks their correlation to your traditional stocks and bonds, and best of all, it pinpoints exactly which assets peak during high and rising inflation environments. It literally takes the guesswork out of diversification. The data we get out of this RASA framework is just incredibly revealing. When you map out volatility during periods of high and rising inflation and compare it to everything else, assets like energy, commodities, and gold cluster in a totally different zip code than traditional equities. The data proves without a doubt that real assets behave fundamentally differently and way more beneficially when inflation is accelerating. They act as this powerful counterbalance, right when your standard 60-40 portfolio is taking it on the chin. Which brings us to the biggest strategic shift of this whole explainer. Section 5, Dynamic vs. Static Allocation. Here's the thing. Historically, holding onto real assets when inflation is low is a total drag on your portfolio. It just is. So the smart institutional answer? Dynamic allocation. Here are the real-time trigger rules to use so you don't fall into the trap of look-ahead bias. First, track the monthly headline CPI data. Second, identify when inflation is high, say popping above 4%. Third, confirm it's actually a rising trend using a positive 3-month change. You really want to avoid those false positives. And finally, only when those specific signals flash red do you deploy your real asset basket.
So when you actually pull that trigger, what does the portfolio look like? Well, you shift out of that static 60-40 mindset and move into a dynamic 48-32-20 allocation. You keep 48% in stocks and 32% in bonds, so you're still capturing that traditional upside, but you carve out a dedicated 20% specifically for that equal-weighted real asset basket. You are stepping up to the plate and actively defending the portfolio at the exact moment the macro environment demands it.
And look, we aren't just relying on theory here. The proof is absolutely in the data. When you look at the mean to volatility ratios of dynamic strategies compared to static ones during high inflation, wow. The dynamic allocations dramatically outpace that static 60-40 benchmark in risk-adjusted returns. By leaning into real assets dynamically, you capture some serious upside and you completely eliminate the performance drag that usually hits during non-inflationary times. It is a total win-win.
Finally, let's wrap this up with Section 6, the institutional imperative. This is all about your fiduciary responsibility.
We absolutely have to come to terms with the macroeconomic reality of the velocity of money. In an era where monetary policy is expansive and yields are artificially suppressed, sitting still is basically a crime. Static savers get totally penalized. Money has to cycle. To survive all this monetary expansion, capital must be moved into productive, cash-flowing real assets. Honestly, idle currency loses. Active, productive capital wins every single time.
So, let's boil it down. What are the definitive takeaways for CIOs and asset allocators today? First, cash is not risk-free. The inflation risk is severe, and it is real. Second, clinging to a static 60-40 portfolio is failing to protect long-term purchasing power in today's world. Third, building a balanced real asset basket gives you absolutely essential tail protection when inflation inevitably spikes. And fourth, deploying that basket dynamically is the secret sauce. It eliminates the drag during low inflation periods, but maximizes your alpha exactly when you need it most.
I want to leave you with one final provocative thought to chew on the next time you're reviewing your asset allocation. Look at your current strategy, look in the mirror, and ask yourself, are you merely holding currency, or are you actively defending your beneficiary's purchasing power? It is a massive distinction. And acting on it, well, that is exactly what separates a standard, vulnerable portfolio from a truly resilient one. Thank you so much for joining me for this explainer. I really hope it sparks some amazing, highly beneficial changes to your institutional strategies.